Format for today, I'm going to do a bit of background to reasons for growth. We then have John Foundling of Menzies Corporate Finance. John was a banker with NatWest for 16 years and has been 17 years in corporate finance. So John will has a presentation on raising funding for growth and growth by acquisition. We'll then move on to Simon Massey, one of our corporate tax partners. Simon is going to outline the government incentives, the tax incentives that are available, research and development, patent box, and the like, which the government's put in place to help us fund growing our businesses and to encourage innovation. We then have Jeremy Hall, our keynote speaker. Jeremy is a serial entrepreneur and gained a reputation for growing his businesses through acquisition, through the dot-com boom. And he's going to discuss his experiences in dealing with that through the 90s, 2000s. We then have a panel discussion, finished by networking and wine and canapes. So, why do we need to grow our businesses? Certainly we feel that standing still is just not an option. Standing still is going to will result in us going backwards. Technological change, new competitors, constantly mean that the marketplace we're in is becoming more and more competitive. If you take some examples, we've got some logos down here of some very well-known companies. Eastman Kodak was formed in 1889. They've been the market leaders in film and cameras for most of the last century. In 1972, I think it was, they actually developed the first digital camera. Because their business model was selling film and chemicals, they actually decided not to pursue the digital camera and to concentrate on their main currently profitable business. Obviously not a particularly good decision at the time, and that's resulted that today they're in Chapter 11 in the States and they're restructuring their business. They do still exist. Blockbuster, again, another example of running a business through change. I mean, we always go to Blockbuster and hire a video. Now, of course, we download it or go to Love Film, and I think they post it to you and you post it back. So it's been a very dynamic world they're living in. Sony, again, Sony were the #1 world electronics company, and they've lost their position to Samsung and Apple. But everyone had a Sony Walkman. But what they haven't done is look to grow in the right way. So although these are very big businesses, I think the same applies to our SME businesses. So growth must be a priority. Limitations to growth, probably the #1 is actually having the right management team. The wrong management won't seize the opportunities, won't be innovative. Having the right products, of course. Poor product will result in lack of growth. Poor product also results in lack of opportunity for growth. And finance. Stuart Flavel from RBS is here. And John will also cover this. Lack of finance will inhibit growth. Certainly very topical. How can we achieve growth? Well, mergers and acquisitions. That's particularly flexible. They enable us to move into new markets, to acquire businesses that have synergistic products, perhaps to different geographical regions. So it can be a very effective way of making an acquisition, and it's not as complex as many people think. Economies of scale, that's growing your business just by replicating what you currently do. So if you have a branch here, having another branch in a different geographical region. Innovation and development of R&D, exploiting IP, enables us to actually gain new markets, create products that don't currently exist. Strategic alliances, again, enabling us to sell our products into different markets, areas that we don't currently work in. The internet has been a massive boom in sales. Some businesses now only trade on the internet. So again, it's another area where we can grow our businesses. Franchising. Franchising enables us to expand our businesses using other people's capital. So if you take Costa Coffee as a good example, and Stuart was saying how much RBS like lending to Costa Coffee franchises, it enables Costa to expand their business by obviously charging to the franchisees, and the franchisees also make a very good living out of it. I mean, Stuart highlighted one that was a former postmaster making £2 million a year, having set up a number of Costa Coffee franchises. So a good way for both the franchisee and the franchisor. And of course, international expansion. Certainly for many of our clients at the moment, looking internationally is of prime importance. You've got China, Brazil, India, the Middle East. These are all expanding economies, areas where we can actually sell our products and services and increase our growth worldwide. Okay, so now that's the introduction. John?
Thank you.
I'll hand over to John down.
Thank you very much. So we're going to talk about how to plan for and fund your future growth this afternoon. So what I'm actually going to cover is I'm going to talk about, first of all, about planning growth and the importance of that. Then I'm going to talk about funding and drill down into the sources of funding to grow your business. And I'm going to cover debt and equity and make a comparison of the two. In addition to that, obviously mergers and acquisitions are another strategy for growth, and we're going to spend a few moments just looking at that and looking at how to achieve successful mergers and acquisitions. So, I'm sure we all know this, mighty oak trees from tiny acorns grow, don't they? Yes, they do. Let me tell you about a couple of examples of that. There was a young boy of 9 years old who was determined to have a business, and he was determined to be a plumber. Now his name is Chris Mullins, and if you came into Waterloo on your way up to London today, you will have passed a business called Pimlico Plumbers. That's his business. It turns over £16 million and is very successful, highly profitable. And Charlie Mullins has been very focused in terms of what he wanted to achieve. But not all businesses start in that way. Let me give you another example. Down in Portsmouth, two gentlemen got together to do a property deal, and they actually acquired an old bike shop. The bike shop still had some stock, and what they actually needed to do was to continue to run the bike shop for a while after they purchased the property. They decided to sell that stock over the internet, and as a consequence of that, Wiggle was formed. And Wiggle, of course, is one of the largest internet retailers of bikes and bike accessories, turning over £100 million. Now, Charlie Mullins doesn't have bank funding particularly in his business. He doesn't like banks, he doesn't like private equity. But at the opposite extreme, Wiggle has actually been funded by private equity on more than one occasion and has gone through a couple of different iterations of buyouts. So, very successful business, very focused, knew exactly what they wanted to do. So when you start a business, where do you start? The chances are that you have an idea that you want to exploit, you have a business that you want to grow. You may not be looking too far ahead as you start your journey in starting your business. You perhaps have a key customer that you want to win, or alternatively, there's a certain level of income that you're looking to achieve, but you have some initial targets and goals that you set for yourself. Some businesses do look further ahead. But most businesses, it's about starting the business, focusing on what they need to achieve, and getting the business moving. But where does that leave you now? You've got a successful business, you want to grow it, but where do we go next? How do we achieve that growth? What do we need to do? Well, you won't be surprised to look back and remember that when you started your business, you undoubtedly wrote a business plan. And you thought about the resources that you would require, and you thought about what you wanted to achieve, and you put it in paper, and you focused on delivering that. And you probably gave yourself some milestones as well. So you had some kind of idea as to what you wanted to achieve. But of course, once you've got the business going, you perhaps put it in the drawer, perhaps it's dusty, because you kind of got comfortable with what you're doing. And you're happy with your business. But if you want to grow the business, you need to get that business plan back out. You need to dust it off. You need to focus on it. You need to give yourself some fresh goals. You need to understand the resources that you need and give yourself some fresh targets. I don't propose to go through the slide in detail. You've got a copy in your packs. Just a reminder for you of the things that one would expect to see in a business plan. But how do you plan the growth? Well, Ralph has already mentioned the opportunities for growth, but growth can come in two specific ways. It can be organic growth from within your business, exploiting your existing products, exploiting your existing customers, selling them the products that you have, or it can be growth on an inorganic basis, by acquisition. and go to a different marketplace, find a different customer base, offer them a different product. And you can go either direction. But probably the direction that you choose is in part going to be determined by your attitude to risk. Is that going to a new geography? Is it delivering your product in a different way? Is it being innovative with the product itself? Is it just focusing on driving new customers? Now, of course, all of these things can be achieved in different ways. At one level, you can invest in your own business and invest in product development. At another level, you could find partners to work with to take a new product to the market. You can form strategic alliances. You can take a minority stake in someone else's business to learn from them, to be able to have access to their products and to sell them to your customers. And of course, you can take that all the way through to a full-on acquisition and actually acquiring another business, then selling their products into your customer base, your products into their customer base, and driving out the synergies from the two businesses. But you won't be surprised, it all costs money, doesn't it? And it really does. And if we think about costing money, there's probably 400 companies every year that are looking to raise significant amounts of capital to grow their business. And that's from a statistics from the Business Growth Fund and Experian of 25,000 companies in the UK, which are turning over between £2.5 and £100 million. And of that group of companies, there are 4,000 that are growing at a reasonable rate anyway. But there'll be 400 that are looking for significant finance to grow their business in any given year. So, where does that funding come from? Well, it can come from inside your business, can't it? There's internal sources of funding. But then there's external sources of funding as well. The internal sources of funding, maybe you have some cash within the business. Maybe that's rainy day monies that you've set to one side. Maybe it was monies even that you earmarked to develop new products at an earlier stage of the development of your business. Equally, you can drive money from your working capital by collecting your debtors very efficiently and perhaps renegotiating fresh terms with the creditors. What I'd say to you about that is be careful, because all it needs is a blip in trading for one of your customers and you can be squeezed and cash can get very tight and you don't want that. But equally, it could be that you've got a non-core activity within the business that you're able to dispose of, to create fresh capital to come into your business, to develop through the opportunity. Or equally, there is the opportunity on the internal sources to call on your shareholders and to ask them to dip into their pockets and to put fresh money back into the business. On the external side, the sources really split into two areas. There's debt and there's equity. Now you can say that friends and family probably cross both, because friends and family probably have lent some money to start the business and they can lend money into the business as equally take a stake in the business. But let's just think a moment about debt. There are different types of debt funding that you can raise for a business. There's the whole ambit of asset-based lending, which can be leveraged against your debtor book, so your customer receipts, all the way through to leverage against your kit in terms of the plant and machinery if you've got a manufacturing business. So there's a range of sources of finance on the asset-based lending side. Then there are banks. And the banks will lend you money short-term for your working capital needs and longer-term for a different purpose. And we'll talk about them a bit more in a few moments' time. Somewhere in the middle here, and not mentioned on the slide, is actually crowdfunding, which is in the ascendancy at this point. And the only comment I'd like to make about that is be careful. It's unregulated activity at this point. It can be expensive. And if you're going down crowdfunding, using the internet and drawing a crowd together to raise money for your business, if you go down that route with regard to equity, you're probably outside of the Financial Services Markets Abuse Act, and therefore actually the investment could be voided at a later stage. So be careful. From an equity perspective, those sources clearly are easily identified. There's friends and family and existing shareholders that we've talked about, but there are business angels. And there's a number of business angel networks around the UK who have entrepreneurs that have made money that are looking to leverage a better return and bring their skills to bear. But equally, there's private equity, venture capital funds and private equity houses who are prepared to put money into growth businesses. Now we mention IPO at the bottom here, and to be fair, perhaps public markets are not as open as they used to be at this point, but they are a source of funding. And when times return to more of a normal basis, then I'm sure that there will be opportunity to raise funds through AIM and through Plus Markets or the equivalent as that develops. But where do businesses raise their funding? These are statistics from a national survey. 22,000 businesses responded to this survey, and it's been segmented by the size of business, which I think is helpful to us as well. And you'll find the sources that you'd expect. There's the bank overdraft, there's the loans from friends and family and directors, there's invoice finance, there's grants. There's a range of different sources that are actually being deployed into SMEs at this point in time. But let's stop and think about that debt market and bank funding. There are conflicting messages, aren't there? And we're aware of them. We don't want the banks to lend recklessly and to lend money that they can't achieve repayments for, because we've kind of seen that happen with what happened in the States and came back over to the UK. So therefore we want them to build their balance sheet, but we want them to lend to fund growth in SMEs. And that's very, very difficult to put the two side by side. But the statistics, again from that same national survey of 22,000 companies, tell us what's actually happening in the market at this point. Of SMEs that went to their bank and requested funding, you can see here again by size that 82% and 89% were receiving what they're looking for, and of the larger size on the loan basis, 84%. The declines are actually quite low, 2%, 5%, 7%, according to size. That's not the perception, is it, of where bank funding is? That's the reality of where bank funding is in this current climate. Bank monies are available, people are not asking their bank. Let's think about what the bank is looking for. You need to remember when you go to your bank that they're not taking a stake alongside you and risking money alongside you to achieve a high return. They're lending you money for a small return, which is interest. And actually, if you stand back and think about what happens if you've got a portfolio of customers, 40 or 50, and you're lending them some money and one of them can't repay it, it quickly erodes the money they've made at 1%, 2%, 3%, 4% over base rate. So it's not an easy scenario. So they're looking for full repayment. They're looking for the return of the capital that they've lent you. That's the essential that they're focused on. So when you go to your bank, they want to see the business plan and a full business plan, and they want to understand what you're going to use the money for. And let's just be careful with that, because in our personal lives, we don't go and buy a house with a credit card. So we just need to think about that from a business context, and therefore think about what we're asking for and how we're going to use it. That's important for us to understand. Of course, we want to think about the banks being repaid. It's important for us, and therefore we actually, as investors now in two very large banks, want to see them being repaid, and we're therefore keen for them to cover the what if. Well, that comes with security. And of course, with security these days, there also is the element of personal guarantees that is quite often requested now of an SME. Your commitment to the business. Now, the government has sought to address the issues of the marketplace. And what happened in March 2012 was a report was presented, which is the Breeden report, that talked about a funding gap in the SME marketplace. And the funding gap, as you can see, is quite large. And government policy has been developing to address that funding gap. But the amazing thing about this particular report are the statistics that came out of it. Only 23% of SMEs were aware of the government's Enterprise Finance Guarantee Scheme. For those of you that don't know what that is sitting in this room, and from that stat there's probably 1 in 4 of you that knows about it, it's the new Small Firms Loan Guarantee Scheme, which is a scheme whereby the government will provide some support to the bank to encourage the bank to lend you the money that you need to develop your business. It's out there. It's available. And actually only 17% of SMEs were aware of Project Merlin, which was the government policy at that time to encourage the banks to lend. It's moved on a bit since then. In their response to that, the government launched a number of initiatives. The first of those initiatives was the National Loan Guarantee Scheme, which was a credit easing scheme, which is to reduce the cost of lending to encourage the SMEs to request the borrowing to help them to grow. And in the period from March to July, 160,000 businesses borrowed 2.5 billion at cheaper rates. So the policy is effective in terms of money is getting into the hands of SMEs. Then there's the Business Finance Partnership, which is a similar type of scheme in the asset management arena. And then there's the Enterprise Finance Scheme itself, which we've already mentioned, with the banks being incentivised to lend more. And then there's a policy that came out of tax incentive called the government's Seed Enterprise Investment Scheme. Simon's going to mention that in a few minutes, but 50% tax break is quite nice. But it's only early stage start-up businesses, as Simon will explain. But why is there an issue? Well, this is the statistics from the Bank of England, because if you look at kind of what's happening to bank lending, okay, this graph speaks for itself. Just focus on the shape of the graph. Bank lending has come down, and if we were to follow the graph on now, it's just flat here in terms of where the graph is going. So bank lending isn't improving in terms of what's happening. Well, why is that? Well, if we look at this survey, again, the source is the Bank of England. Look at this. Demand is down. It's only the small micro businesses that are seeking additional funding. You guys running SMEs looking to grow your businesses are not asking the banks for money. That's what the survey tells us from the Bank of England. And as a consequence of that, the availability of that funding is kind of actually fairly neutral. And that mirrors the graph that we've just shown you, and the previous graph. I wonder why that is. Well, maybe the perceptions are helpful for us here, because the perceptions from this survey of CFOs in larger corporates is that actually it's hard to get and it's going to cost you more. Okay, those stats might be changing slightly in terms of where they're headed, but that's the perceptions in the marketplace. But what we can tell you is that the government has continued to incentivise the banks to lend. The latest scheme that the government and the HM Treasury has come out with is actually the Funding for Lending scheme. You've probably seen it advertised in the papers. You can see bank adverts with little Union Jacks in the corner. It's a collateral swap scheme, if you want to get technical about it. But really, it's just an encouragement for the banks to lend money to their SME client base by providing them with funds that are cheaper. So the more they lend, the cheaper the funding gets for them. So the bank is genuinely incentivised to lend, which is great. Now, the other piece of news sitting here, of course, is what we've heard but not seen the rest of the details on, was the announcement of a government bank being formed, which will be £1 billion to come in. Well, not of the same size, of course, of this 80 billion up here, which relates to the existing stock of lending, but it's still a big number because you would leverage that, and there's £11 billion potentially to come into SMEs, but maybe 18 months away. But I still think it's a positive sign in terms of the ability for you to fund the growth in your business. But let's talk about debt in a bit more detail. There are pros and there are cons with debt, aren't there? Of course there are. The pros, you retain ownership of the business. The repayments of the facility are not linked to the performance of your business. I know there are covenants sometimes, but not totally linked to the performance of your business. Now, the downside of that, of course, is that if your business slows, you still need to make sure you repay the bank. We know that, don't we? These are the pros and cons. It is straightforward to set up. It is cheaper in terms of the cost of putting the facility in place than equity, because the risk is different. The equity provider, the shareholder coming alongside you, is going to take more time and give it more attention before they're prepared to put their money at risk. Simon will hopefully support this as well. It's tax deductible, which is also extremely helpful in terms of the interest costs. The downside, of course, is that there can be covenants. The downside is, of course, that they cover the what if, and they will be looking for some security. That can be personal guarantees. And of course, the other area we've got to be very careful of is that too much debt is unsustainable. So we need to kind of watch out for that as well. Now, what are they looking for? We've mentioned this already. Lenders are looking for repayment, and they're looking for return, interest, and they want the what if covered. So they're looking for some security. On the other side, an equity provider, an investor, is looking for growth. Looking for a return as a minimum of 2 times their money. And of course, what comes with taking that additional risk generally is a greater degree of control. So how do we graph them if we're trying to look at risk and rewards? Well, actually, of course, therefore, in the top right-hand corner, high risk, high reward is equity. Of course, if you're growing your business using your own cash, it's actually low risk, as long as you use cash that is genuinely surplus from the business. Somewhere in the middle here is actually where the bank debt or senior debt would lie. But actually, what is also available in the marketplace, and there are several sources of funding available, mezzanine funding, which predominantly is unsecured funding, looking for a return that's above bank lending but below someone taking a share stake in the business. And just to kind of put this all into context, we've then actually put on this graph as well that the equity investors usually gear their investment and actually will use instruments to put their money in as well, so some of it will be in unsecured loan stock and preference shares. But that's about driving and ensuring their return and can actually be very helpful to the business in terms of how it works. So, do they succeed? Interesting. The red line is the only line I want you to focus on for the moment. Venture capital-backed businesses from 2006-07 to date, how have they performed? Data from Experian, published by the British Venture Capital Association, shows quite clearly that turnover has increased, gross profit has increased, and on an efficiency basis, productivity has increased in those companies. You'll notice it's not necessarily straight away, as we can see in the two graphs here, but over time, venture capital-backed businesses grow. The stability is greater. They have an opportunity to grow. But it's not all about money. I'm sure Alistair from the British Growth Fund, who's with us here today, will be able to confirm this for us as well. It's about engagement in the business that the venture capital or the private equity house will bring. It's about their network and their contact. It's about their general expertise of investing in other businesses that have gone through the same growing pains as you have. And not all venture capital businesses succeed, so they know about how failures occur and how to avoid those scenarios. So they can be very helpful. It's not just about money. But when do they invest? Well, actually, there's a huge spike in the graph here, isn't there, which is about MBOs and MBIs, which actually is about passing your business on to the management team or the next generation or that generation and the one after and taking some money off the table. But actually, from the very beginnings of your business right to very late stage, venture capital is available for your business in terms of funding your growth. From start-up, there are funders there, all the way through to a mature business looking to go to the next level. And the spike with the MBOs, MBIs is because you can do an MBO at one level and then actually sell it again, which was the example of Wiggle, where there's been a couple of MBOs, and as a consequence of that, there's a lot of interest in that area in the marketplace. And it's helpful for you, it can be very good for you. But what are the pros and cons of equity? On the positive side, the equity investor is sharing the risk with you. They're bringing expertise, as we've just seen. And they have deep pockets. They'll fund your growth going forwards. Not just today, but tomorrow and into the future. The downside, we talked about them requiring a 2x return on their money. They genuinely do. And there can be hurdle returns that have to be met. You've all seen Dragon's Den, they can drive a hard bargain. They don't always, but they can drive a hard bargain. And it's important for us to recognise that. But they're taking real risk. They will impose some controls and get involved with the business, probably appoint a non-executive director. That brings positives, but at the same time, there's a degree of control that you've given up. Because a private equity investor will not just look at your business and the financials and the tax, they'll look at the marketplace and the commerciality of the business. They'll look at the management and dereferencing. They'll look at the insurance. They'll look at the legals. There is a whole plethora of areas that a private equity investor will potentially explore as part of their due diligence exercise. And you won't be surprised that costs a little bit to achieve. It can be time consuming to secure, and it can be hard to find. But I've shown you statistics that show you that across the various stages of your business, it is possible to raise money, and those stats were deal volumes in each of those areas. But the reality is, and this is a diagram, a graph that's come to us from the Business Growth Fund, it's actually quite helpful because really starting your business is about the journey, isn't it? And when you start the business, you probably did max out your credit card and empty your bank account of cash and put it into the business and live on a shoestring for a while. And then you probably tapped up the family and someone else put some money in, and then actually you got confident enough to go to the bank and have a discussion, and you borrowed some bank money, and then actually as the business grew, you brought someone else in to get involved with the business. And where the Business Growth Fund fits is to fund equity in what's perceived to be an equity gap of £2 million plus. And equity is available to you to invest in your business. So the chances are, across the journey of your growth, you need different types of funding. And it will be a blend of funding that you take to achieve the growth that you're looking for. The next slide really just gives you the key for the diagram, and you've got that in your packs. So what have we talked about? We've talked about planning growth. We've talked about funding, and we've compared debt and equity. But when we talked about growth, we said that there was inorganic growth. There was the opportunity to think about mergers and acquisitions. So just for a moment, let's just talk about mergers and acquisitions. Let's think about whether they do create value. And we'll show you some statistics. Let's think about how do you de-risk M&A. And of course, I'm a corporate finance advisor. We do the deal, we pop the champagne, and we disappear over the hill. But the key point is this, and I want to kind of highlight this to you as well. It's about delivering the original plan, driving the integration, doing what you intended to do, and driving the growth in the business. So we'll talk about that for a couple of moments as well. So the statistics, and this is a survey from Accenture, 2002 to 2009. Yeah, I'm sure there's analysing statistics, you can kind of cut and dice it how you like, but across this period, 58% of deals completed added value on the basis of a total return to shareholders. That's pretty good. It can work. If we look at this though, there are 22% that significantly destroyed value. Value fell by more than 20%. So be careful, it's not without its risks, but it can be successful. So let's talk about driving success and de-risking it. It's about three different things really. It's about the strategy to start with, it's about managing the transaction, and it's also about that final piece, that integration and that delivering of your plan. So let's talk for a moment about that strategy management. We've talked about building your plan, and you think about the resources, you think about your products, the marketplace, and you pull that together, and you've got a clear view as to who you want to acquire and why you want to acquire them. Where are the benefits to you? What is it going to deliver for you in terms of profit and cash, etc. Spend time doing that. Think about it. Follow it closely. And don't divert from the plan on the basis that you've agreed it and you've convinced yourself that's the right strategy to follow. Very important. Then when it comes to the transaction itself, yes, it is about negotiation, and you need to get that right. It is about structuring the deal, and we'll say a bit more about that in a few moments' time. But then it's also about due diligence. You've set the strategy out, you know where you're going. But actually, you need to deal with the transaction correctly and negotiate the best deal that you can, but check everything. You're going to need to do due diligence, and you're going to need to get professionals involved to do due diligence alongside you to reduce the risk. And then that last piece is around the integration and actually planning and implementing. So the deal. Let's talk about getting the structure right. In structuring an acquisition, you don't have to pay everything on day one. Yes, there's a piece of initial consideration, but you can have deferred consideration. But in addition to that, you can have deferred contingent consideration, which in everyday words is just an earn-out, which means you can pay relating to the performance of the business in the future, which can be very helpful to you. So get the deal structure right. That's important. But when it comes to the funding, get the debt structure right as well. We've axed that credit cards and buying houses and all of those good things, and don't forget them. So the debt structure is important, and therefore think about senior debt. Is it mezzanine debt that you need as well? before you turn to equity? Is it equity you're going to bring in? What are you going to do? Think it through. Get the structure right. The structure will give you solidity and therefore give you the right platform to grow. Leave sufficient headroom to make sure you can absorb shocks in terms of a change in the market conditions, or actually the loss of a customer that you didn't foresee in the process, or even growth that you didn't foresee that then puts pressure on your cash flow. But that final piece here says maturity blend. What do I mean by that? I'm back to this whole issue of making sure that you have some short-term, some medium and long-term debt within your structure of your business, because it gives you that strength